Good afternoon, everyone. I'm Danny Leipziger, and it's my great pleasure to introduce Makhtar Diop, who is the Managing Director of the International Finance Corporation, the private sector arm of the World Bank Group. We've circulated his bio, but briefly, prior to taking over the IFC, which has more than 4,000 employees, according to AI, and commitments above 56 billion. Makhtar was also previously the Vice President at the World Bank for Africa, for the region, for 6 years, and then for the infrastructure part of the World Bank for another 3. So he's got tremendous experience, and I'm delighted that I can welcome you to GW.
Thank you so much.
So I'm glad to see you all here, and I'm glad Makhtar could join us for this discussion in the realm of international business in the turbulent era that CIBER and the business school is putting on. I wanted to, I was also remiss in saying that at one point Makhtar was the Minister of Finance of Senegal, so I might have to call him the Honorable Makhtar Diop.
No,
so for those of you who don't know about the IFC, which is 2 blocks away, I want to start, Makhtar, by asking you a couple of questions about what the IFC does, in particular, since you took over in 2021, how things have changed, what priorities you have instilled, and how the IFC is doing.
First of all, thank you very much. And it's a pleasure for me to be here with a friend. Danny is not only that I'm here as head of IFC, but I am here with a friend, someone who has been influential in what the World Bank Group has been doing so many, many years, with an extended experience in Latin America, in Asia, in a PREM, in a lot of things that we did. So, Danny, thank you very much.
Thank you so much. And I'm only 33 years old, so I had quite a career.
And it doesn't change. Let me just put a little bit things in perspective. IFC is 72 billion last year. We moved from 55 to 72. And I doubled a little bit the annual commitment of IFC since I took over in 2021. We are 80% roughly of debt and 20% of equity. But let me tell you why IFC is today what it is and what is the history of this institution. Back in '56, there is something called IBRD, which was trying to rebuild the wall after the Second World War, which was built. And at that time, the idea was that the public sector was the only body which could really rebuild an economy after a war. Later on, in '56, people realized, and let's not forget at that time, there was a big ideological debate between the role of the public sector and the role of the private sector. And even in the Western world, there was a strong belief that the public sector should be playing a major role. It was a time where in a country like France, you have large state-owned enterprises, which were a major engine of growth in those countries, and where the manufacturing sector and the productive sector was concentrated. In '56, people realized at that time it was also where in the international debate, we are seeing much more people believing in market principle for economic growth. People realized that there was something missing in supporting countries in the developing world, particularly the private sector. IFC was created. 1888, another part of the World Bank Group was created, which is MEGA, because people realize that even if you bring the private sector somewhere, there is a political risk that needs to be addressed. At the time, you had coup, you have instability in a lot of countries, and the political risk was heightened, and people realized that we needed a body. So these 3 elements constituted what today is a World Bank Group. And at that time, for those who have studied development economics in those years, there was someone called Chenery who had developed a model which was a 2-gap model, which was after extended as a 3-gap model. But it was interesting because that's what inspired the World Bank Group in doing their projection, in looking at how we should be matching saving and investment in country to be able to create the condition for sustainable growth. But as we are moving, an institution like IFC was, and the World Bank at that time were providing liquidity, which was missing fundamentally to fill those gaps that I mentioned. And there were a need to bring liquidity. And the role of IFC was to bring liquidity from the private sector. But the needs and the growth that we have seen in emerging countries show that the gap and the need was much larger than what our balance sheet can support. And you know, I don't know then if you show them the work that you did when you were in East Asia. You know, he documented a lot this growth trajectory and the role that the public and the private sector were playing in the growth, what they call at that time the East Asian miracle. So this is where IFC today is. We realize that our balance sheet is not enough to be able to support all those needs of developing countries. And we decided that we will be changing our approach, that's what we call today IFC 2030, from using solely our balance sheet to finance the private sector and to use our balance sheet now as a catalyst to leverage, to mobilize resources, and to be able to attract the capital, the private capital, which is available in the world and which is not necessarily and targeted going enough in low-income countries and developing countries. Even though we have seen in some of them, like India, like Brazil, what you call the BRICS, something different. But for the vast number of developing countries, we still have a low level of FDI, a low level of private investment. Just to give you a number, today we talk about 2% of GDP going into FDI, which is very, very low. So this is a little bit what IFC is doing, and the reason why we are where we are today. And I think that we have interesting challenges, but we have an important role, and I can explain what is our role.
Very good. Thank you so much for that introduction. Let me pick up on 2 or 3 things that you mentioned. The first is you said the IFC is now 80-20 between lending and equity. And so one question maybe people in the audience would like to know is, how does the IFC decide for a particular firm or investment whether it's going to be a loan or whether you're going to take an equity position? And then the second it has to do with the leverage factor. So you were the VP for Africa for 6 years. You know, on that continent, for example, the infrastructure needs are dramatic, and there's no World Bank or IFC or African Development Bank that's going to solve it. How do you see the IFC's leverage, and how do you reduce the risk for some of these investors so that they invest? So first, equity versus loans, and second, leverage.
When you look at developing countries and more emerging markets, the resource which is the most in demand is equity. Most of the firms are over-leveraged. It means that in practice, people don't have enough capital. They go to the bank, and there is often a mismatch in the maturity of the investment that they have. They have to buy machinery that they have to amortize and over a long period of time, but they have only access to short-term debt, which forces them to do a lot of revolving and increase the cost of capital and so forth. So there is an important mismatch in terms of investment need and source of financing. Please note also that in those countries, the capital market is very shallow, it's not deep. So people are not, and the institutions are not as strong, so people don't go to the market to become public easily and be able to mobilize domestic saving in those countries, which in addition is at a very low level. So all that combination makes that we need to, it's important for an institution like IFC to provide equity to companies. Where equity is risky, equity takes more of your economic capital as an institution. So when you do equity, you have to think very carefully about a certain number of things. The upside, the downside, if you can exit, because our idea is not to own companies for the sake of owning it. This is what investors on the capital market are doing. Us is to create the condition for those companies to grow, and once they have grown, to go to exit and sell them either on the stock market or to have a private placement. So what we're doing is that we're looking what are the sectors where we can create more jobs, where there is a need for transformation of the economy. needs to export more, and we focus on those sectors. We also do a lot of venture capital, VC, because we are seeing a lot of small investors who need capital. So what we are doing now is that we are increasing significantly the amount of equity investment that we are having. We are planning to double it, which is a large amount. We are the largest investors on equity, for instance, in Africa by far, and other part of the world. We need to de-risk a little bit that investment. And we are now working with grant money from countries or for philanthropy to be able to have a first loss which is absorbed by this grant money that is provided, so that when we go there and when we mobilize people from the capital to invest in some equity, they have the appetite to invest in it. It's important to note a little bit the evolution of things. Danny was there when we were negotiating COP21 in Paris. At that time, when you go to that place, you have the philanthropy on one side, you have the public sector on one side, and nobody was talking about the private sector. And in fact, there was the idea that either I receive grant only for whatever I want to do, or I receive a loan. But there was no the idea that you can take grant money and soften the term of this loan or the risk associated to a loan in the private sector so that you can really increase the pie. So trend now is to work more and more with philanthropy, with government, and convince them that they can get more investment in their economy if they use the grant money that they're receiving to de-risk investment and attract investment from people. Another question that we are dealing with as we are talking about equity is that when do we do direct investment or when we go to fund? So you have a lot of small companies in developing countries, and it's very it's not very cost effective for us to go and try to invest in every single company because we don't have the labor force. So what we're doing is that at the lower part of the pyramid, we are we're investing in funds, and those funds invest in those companies and take equity in those. So more we move in the curve, and the more the company becomes larger, we are investing in equity directly in these. And all this, we're doing it with other partners from the private capital market, but also we are bringing more and more institutional investors to finance part of it when it's needed.
Very good. So when we teach our students about FDI, we always indicate the kinds of things that are relevant for a country, and I sometimes say it's a beauty contest. You have to compete. You have to show that you've got better institutions, you've got better labor force, you've got all these attributes that FDI investors are looking for. So I know the IFC is also involved in institutional development, regulatory reform. So I wondered if you could focus on that a bit. How active are you, and what's the relationship between you and the World Bank in providing this kind of advice to countries?
No, thank you very much. And let me tease again Danny, because he was director for infrastructure and private sector and finance in Latin America, and I succeeded him in that position. And one of the discussion at that time was quite interesting. He was, you remember, the fiscal gap that we have in investing in infrastructure.
Right.
I'm saying that because it's a little bit the conversation that we start having more and more today. As we are moving in attracting investment in countries, we have, with the president of the World Bank who comes from the private sector, creating what we call the PSIL, which is the Private Sector Investment Lab, where all the BlackRock, all the whoever Temasek, everybody is there. And it's an interesting group because it allows you to have an idea of what are the constraints faced by the private sector in investing in emerging countries. So we are the 20 of the top private capital and investors in the world. I gave some of the name, but really, this is the who of investors and asset managers. And we asked them the question, what are the constraints for you to increase your investment in developing countries? And they gave us some indication, and we have been working with, across the World Bank Group and our president, Ajay Banga, to solve those issues. The first one was policy uncertainty. When an investor wants to come to a country, they want to have predictability and certainty and rule of law and all these elements, number one. Secondly, because you don't have enough of that, they need guarantees. Third, they want, I was talking earlier about the maturity mismatch. There is also a currency mismatch often that investors are facing. So how can you invest in local currency? The fourth one is that they would like to see if we can work together so that we can help them not to keep on our balance sheet all the investment that we have done, how we can transfer it to the market and better increase the velocity of the use of resources from our balance sheet. Those are the kind of issues that we've been working on and looking at very closely in these past years. We have put all, in the World Bank Group, all the guarantee business, which was a little bit distributed across different parts of the World Bank under one umbrella, MIGA. We are repurposing our policy lending. It's a little bit coming back to some of the debate that we have in the past, where people have moved a little bit at some point to general budget support instead of making it more sectoral linked budget support. In our jargon, it means that when the World Bank Group goes to a country, you discuss about the main reform that you have. At some point, we were focusing a little bit too much on just the macro conditions and not focusing enough on the discussion on the sectoral constraints that will, in fact, attract the private sector. So we are rebalancing a little bit that and doing much more something which looks a little bit like the old SECAL, okay? Where we are trying to bring much more of the sectoral reform needed to attract private investment. We also need to look at things like, de jure and de facto. Often, if you look at the documentation, the law in countries, they are not fundamentally different from what you have in developing countries. So for us, working infrastructure, for instance, that we do have an independent regulatory body, that we use APIs minus X for pricing, that will, all these kind of good things. But the reality is that de facto, the regulator is Central African Republic, even if he has the same institutional design as a regulator in London, they are two different animals. So we try also to move to de jure to de facto. And that gap is filled by having the right data to measure the effectiveness of institutions, and particularly for the private sector of regulators. And I give you an example of the things that we're trying to think. If you have a regulator, and empirically you can see that there is a bias in the way he addresses the complaint of the consumer, you can ask your question, is he really independent or not? So this is a kind of question that we are working on to make sure that the private sector not only has the right regulation, but in practice, we have a way to trace a little bit that. So that those are element qualitative, but you do also some qualitative surveys where we are looking at it. We have an instrument called the Be Ready, which is the old doing business, which is trying to capture all these elements of inefficiency in doing business in a country, and we serve. Secondly, we have some things that we have done last year, and has been just released, is GEMS, where we try to show we had a lot of data on the default rate of investors depending on geographies. And this was an effort that we did with other investors in the DFIs, and we have gathered a very good database that allows today people to realize that the credit default rate is not higher in some of the countries, and therefore reduces the perception of risk that investors are in country, and therefore it reduces the premiums that they put in when they're investing in those countries.
Well, I think you've mentioned 2 or 3 aspects of reducing the risk to the investor. One was the first loss kind of thing. The second are the guarantees that MIGA and other put. And then co-investing, and we used to call A loans, B loans, but they're
exactly.
some combination. So in general, the private sector doesn't like to lose money. They would like the IFC or the World Bank Group to be first in line. But on the other hand, you are using this as a carrot to stimulate much more investment. So this private lab, this private sector lab that Ajay Banga has started, to what extent has that mechanism fostered increased flows? In other words, what's the leverage that all these guarantees and other instruments have generated? So apart from your direct IFC involvement, you also can stimulate other flows. How is that?
Absolutely. It's quite new, but we are already seeing an uptake on the guarantee business of Amiga. They have really seen a
It's the Multilateral Investment Guarantee Authority or Agency, Amiga. Yeah.
I forgot to mention that. If you don't understand one of my acronyms, just tell me, because sometimes we get carry on with our. So the guarantee part of the World Bank Group business demand has been really increasing steadily. Secondly, we have a good test case, which is now the initiative called M300. M300 is an initiative by which we are aiming at connecting 300 million Africans to the grid, out of the 600 million Africans who don't have access to electricity. And for that, it requires a lot of investment in different segments of the power sector, being distribution, transmission, generation, decentralized renewable energy, all these kind of things where you need to have investment in. And today we are seeing those elements that we mentioned be translated in what country calls the compact. I just came yesterday, yesterday from New York at the UN General Assembly, where they had the second batch of countries which came with the compact, where they capture the 3 elements that you mentioned. The policy reforms that they will be taking to reduce uncertainty, the investment that will be needed. And roughly for that exercise, we see 1/3 coming from government. And there I will make a parenthesis because it comes back to the fiscal space issues. Convince IMF that it's important to create some fiscal space for government to invest in infrastructure. So a debate that you know quite well. That is the first one. The second one is the 3/3. The second third is DFI, us. And the third one will be private sector. That's the way we are distributing it, and we are seeing already in this test case that things are being picked up and moving that direction. We have also done a lot of innovation last year with participants in the capital market. Interesting things in different parts of the world. For instance, there are some interesting instruments for banks which are moving from Basel II to Basel III, whereby the requirements are so high, and the banks like Société Générale and so forth, when they have, when they are present in some of the market, don't want to use too much of the economic capital because the Basel III requirements are really taxing on there. So what we're doing is that we're developing things like the synthetic risk transfer that are used to be able to reduce the capital use to be able to meet the Basel III requirement. And we are not doing it, that's why the developmental part of IFC intervene. We are not doing it just for the banks to have more. We are doing it with targets of investing in SMEs, investing in women-led companies, invested in greening the supply chain, something like that.
Well, the role of these banks, I mean, you mentioned before venture capital. So in a previous panel, they were talking about the fact that one of the big challenges across the globe is productivity. So we don't know that much, apart from Bob Solo. To say that it's related to innovation, and innovation is related to startups, and startups need to be funded by venture capital. In emerging markets and developing countries, it's harder to get that kind of money. So are there special windows at the IFC, or are there funds that you can invest in that will do this venture capital? Because the standard banks, around the world, and they like to invest in government paper because it's safe. So venture capital,
Yep.
Are there mechanisms to promote that so that there are more unicorns coming out of the emerging markets?
I was in India 3 weeks ago, something like that. And it's where our equity portfolio is the largest. It's one of the most dynamic PE market in developing countries. And I met a lot of the people on the VC front. Mm-hmm. Just the innovation that people are. The frontier now is to have venture debt. Mm-hmm. Okay, because people say we have venture capital, but we don't have venture debt, which means that sometimes this is what is needed for us to grow. So there is a little bit of the conversation, and it's something that is not widespread at all. Okay, we're trying just to move on the ladder on that direction to supplement those who are in the venture capital space with some debt as well, to be able to have.
So this is in between equity and debt.
Exactly.
Venture debt.
Yeah, venture debt, that's something that we look at. We develop also instruments like we are using a lot of mezzanine, so quasi-equity instrument, to be able to bridge those gaps and the needs that we have sometimes in companies. And for instance, for these quasi-equity instruments were quite important because sometimes you don't have yet the confidence that you're going to go fully on equity in a company, but you want to give them an opportunity to grow. So we have these instruments like mezzanine, quasi-debt, etc., quasi-equity that using. And now for the venture capital, they're telling us it's nice to give us some venture capital, but sometimes we need some venture debt because the capital market doesn't support us to move in this. So this is something that we are doing, but we're working also a lot with the fund. So whenever the lower we go in the ladder, the more we work with the fund, and we have funds which are regionally specialized, and you have those which are specialized by themes. And in 2030, IFC 2030, we are aiming as really developing our ability to map the investors depending on their interests, the regions, the nature, the segment of market, and to when we talk to the client, to have at the same time a menu of investors that we can tap on immediately to co-invest with us or to be mobilized.
Okay. Very good. So let me move to a little bit broader discussion about development, since you were in various jobs before the IFC. So my question here, and maybe it refers more to the World Bank Group than just the IFC, is whether or not the advice that your teams are giving has changed over the last 10 years, let's say. So I'm referring to industrial policy, forgetting about tariffs, but just national economic interest that's pursued through a variety of new avenues. We both know that in the past, East Asia did well, but a lot of other continents did very badly with a lot of these industrial policies. But it seems to me it's harder for institutions like the World Bank to take it off the table ex ante because advanced economies are pursuing it. So just from the vibe around the World Bank Group, are you feeling that some of the advice is a little bit more nuanced these days, or a little bit more open to it? I mean, I don't know.
I was with our friend in the meet just an hour ago.
Yeah,
And
he's
we're
the chief economist.
Chief
of the
economist
World Bank.
for the World Bank Group. And we're discussing it. It's clear that today, when you wrote when you were working on the East Asia miracle and so forth, at that time, what you were saying is that it's not one size fits all. We need to look at country-specific conditions and so forth. And, I don't think that in the current context, the debate on industrial policy is back, even within the World Bank. Mm-hmm. And actually, people are asking themselves, we are the phase, in the development and economic things. There are some phase of relatively calm. Okay, so 10 years ago, everybody agreed that inflation is bad, deficit is bad. You need to be financially integrated. You need to trade. You need to multilateralism. Everything was flat, and people were just focusing on firm productivity to be able to be things. So all the work was technology adoption, productivity of labor, all these kind of issues. I think that we are entering an era which is different, where a lot of these elements of stability in the thinking are being challenged by the reality around us. You cannot take to a country, just say, okay, now just export goods where you have a comparative advantage on labor for different reasons. One of them is technological change, because now with the robotics, AI, 3D, maybe some processes which were labor intensive and competitive might not be, the way. Secondly, you have the views on international trade which have changed. Third, there is also some element of the social contract in some countries which are creating some tension in making those advice things. So I think that what I'm seeing more and more, and that's why actually we are focusing, and that's what Ajay asked us to focus, is on the job agenda in countries, but also to think about a regional supply chain. Mm-hmm. Okay, I think that we were thinking about international supply chain and maybe less for some of the countries on regional supply chain. Asia was able to do both, right, to have very strong regional supply chain and be able to export on the international market. The best example is these machines. Okay, other part of the world were not able to do that. Right. Just be integrated in the international trade, but under-integrated regionally. So we are kind of looking at it now more from a regional integration and a supply chain and value chain in sub-region to take into account all these constraints that we're facing now.
Right. No, it's very interesting what you say. I remember when I did my first economic report on Korea, on industrial policy, colleagues told me if I came out saying industrial policy was a good idea, my career in the World Bank would be over. If I said it was bad, the Korean government would never speak with me. So it was supposedly a lose-lose situation. So I'm interested that
but even if he's not politically correct with you as student, then he knows how to find the fine tune, the fine.
So I managed to survive. So I have a couple of other questions, and then we're going to, this number here tells us when we go to questions from the audience. One question has to do with coming back to FDI again, which is interesting. In some countries that I've seen, the FDI story is seen as one of the solutions to their problem. I'm talking now about Cote d'Ivoire, which may not be too different from Senegal, because savings are low, et cetera, and FDI can connect local industry if they have it to the global value chains, et cetera. But FDI is not managed by a powerful ministry. It's very amorphous. There's an FDI authority, but then the Ministry of Energy does that, Ministry of Roads does this, Ministry of Ports by somebody else. There is no integration of all of the constraints that I'm sure your private sector people and this Be Ready report will identify there's no way to integrate this into an FDI strategy, and then to get all the ministries to play ball so that you get the right kind of investment. The previous panel was talking about smart decisions, so you'd also like to have smart FDI, which brings in a lot of benefits. So is there some mechanism in the IFC or in the World Bank Group to try to get the FDI strategy more firmly coordinated and identified so that countries can be more successful?
Yeah, we are currently, that music you hear, moving much more on the knowledge bank. And we are trying to pull all our experts across the World Bank Group together. Okay, the specialized experts, those who, and it will be helping in fostering a dialogue between public-private sector within our World Bank Group, which is important, so that when people go to meet the client, they have the private and public solution. Let me talk about my experience in my life before the World Bank Group, which is a long time ago. When I was Minister for Finance in my country, I came and with a friend of mine who was working actually at JP Morgan, Shakan. We brainstormed and we discussed about FDI. So at that time, when you look at African economies, if you have one or two people at the city of London or in Wall Street, which are looking in detail at those countries, you are lucky, okay? So because the volume, the margin was not interesting. So basically, they are bundling countries, and there were some proxy. Do you have a program with a fund? It means that you are in trouble in your macro. Do you have a program with a fund? It means that your debt, are you a hippie country, yes or no? You are trouble in countries. So there was no nuance among all these countries and things. And so what at that time we did is we say, okay, what speaks to the market is rating agencies. And besides South Africa, at that time, no African country has done a sovereign credit. So we went on the market with S&P. And it was interesting, just to give you an anecdote on the political economy. My president at that time said, Makhtar, do you know what you're doing? Because are you really sure that you want to do it? So, this is a job of in government. I told Mr. President, if he works, you take the credit. If it doesn't work, you fire me. You say that there is this guy coming from the IMF who has some funny ideas, so you can get rid of me. So he worked, okay? And he was able to go to market and explain. What I want to say by that episode is that you need also to talk the language of the market. And at that time, it didn't have. And we had the second leg of that strategy was investment promotion agency, which was developed where people, after we did the credit rating and we put the one-stop shop and all the reforms that we wanted to take, we have someone who can go and talk to the market about it. And at that time, you'll be surprised, just to tell you how the perception is completely different. At that time, Senegal had the same credit rating as Turkey. And in nobody's mind, the market will have thought that, okay? Yeah. So when you come and explain, you are distinguishing yourself from other, and you can. Since then, it became replicated by a lot of countries. But a good thing can also turn into a less good thing. It's not very used. Because of that, countries start going and borrow heavily on the market, because now they had a credit rating, and there were, at the time when there was a lot of liquidity on the market, a lot of African countries went and borrowed heavily. Just to give you a sense, when I was vice president for Africa at the beginning, it was after the debt issue was kind of handled, it was 25% of GDP on average. Country. Today, most of the countries are more than 75% of GDP. If you borrow well for productive sectors, that's good. But if you don't do it well, you can think. And what we have seen at that time is that country borrowed often at short maturity and in dollar. So they had a currency and maturity mismatch, which when it comes and the market conditions are deteriorating, you can see the impact that it has on your fiscal and on your growth. So this is something that started well, good experience, but if you are not carefully managing it, you can also do, and it's the same story with industrial policy. You can start well, have good intuition, have good idea, but also you can mismanage it and create a situation of overprotection, of chronism, or whatever, which leads your economy to tank instead of growing.
Very sage comments. Thank you so much. So we have 3 minutes left. My last question to you has to do with, I don't know how many students are in the room. It's hard for me to see. I see some elderly people in the front, but I can't see everybody. So students are in the business school. We're seeing what's going on in the world, you know, geopolitical issues, fragmentation, trading blocks, tariffs, and you know, the world that we were teaching 10 years ago of globalization having all these benefits, Joe Stiglitz notwithstanding, is no longer the world we see.
Yeah.
So my question to you is, for the students in the room, how do you see the global business environment, and what is it that they should focus on or not focus on? At the end of the day, they want to get jobs. They all want to get jobs at the IFC, but I know that's not possible.
You have a lot of people from GW actually at IFC.
But anyway, what's the word for the student population here?
I think it's a world where we need to live with uncertainty and manage uncertainty. Okay? I think the uncertainty is coming from, since I take a vector, there are so many elements of uncertainty today. Yeah. What is different from previous episodes, you know, the 2008 crisis, the 2018 crisis, is the vector was very, you know, you'd have one or two type of shocks. It was monetary shock, it was balance of payment shock, etc. Today, what makes the situation different from the past is that the nature of shock is so heterogeneous and so multiple and so simultaneous. That's what makes it so difficult, I think, for a policymaker today to adjust in things. And you need to be very pragmatic. Let me give you some shocks. Here you have something, a generalized purpose technology called AI, which is now here. A generalized purpose technology means that it will change fundamentally the way the production of goods is made. It's like electricity at some point. So some argue among economists is it a GPT or not, but a lot believe that AI is a GPT. So that will change fundamentally a lot of things. We have the uncertainty on trade today. We have the uncertainty on risk associated to pandemic, to things like that. Think about it. 3 years ago, we were all locked somewhere and we weren't able to leave our room. We never seen something like that. Yeah. And we have the heightened frequency of shocks, of major extreme shocks. So this is something that today a policymaker has to deal with at the same time, which was not at all the world of policymaker 10 years. So you are going now for business school and be creating new businesses or working with people. I think that not necessarily be driven by the short-term movement. That's what I would say. If today one is only looking at the short-term movement, you might not be able to make the right decision, particularly if you build a business. It's difficult, very difficult, because there's so much distraction in terms of multiple shocks coming to. Have a bit of a longer-term perspective. Try to extract the permanent trend on it. It is difficult, but I think that but if you want to make money, obviously you will be using the fluctuation. But if you are here in the long run and we are not just trading things, you need to kind of build some buffers and realize that this situation might be coming to a stable equilibrium in a few years, and that we are in a turbulent times. That's a part of the economic story. We have always some episode of turbulence. We are entering one which are more complexity than the previous one, to my view, because of the various elements that we discuss. So that I can say. but I'm sure that
And that's the name of our conference, International Business in Turbulent Era. Please join me in thanking Makhtar. Thank you so much.
thank you. Thank you.
I knew you'd be good. I didn't know you'd be great. But, we have a mic in the center, and oh, here it is. And so we have time. I can't see that far. We have time for a few questions, and we give preference to students. But anyone wants to come up and ask a question, please tell us who you are and address the question. Any takers? You have to come to the center.
First of all, thank you, Mr. Makhtar, for being here. And I also want to thank IFC and you because they gave me the opportunity during these summers to be part of the IFC and learn a lot as an intern. And my question to you is that given the recent shifts in the political environment and the global policies, we see many countries now prioritizing their national interests over the globalization, and we see the globalization is on now new trajectory. And this trend has significant impact on the private firms, especially the SMEs, which are the great part of the IFC's portfolio. So how does the IFC view this shift, and what strategies are you considering to help these SMEs to navigate and thrive in this environment?
Okay, we'll take 2 or 3 questions. The first one, SMEs. Thank you very much for your question. Sir.
Thank you, Mr. Diop. My name is Barry. I'm a senior studying international affairs and economics, and I appreciate your talk today. My question is regarding international lenders. So international lenders traditionally attached strict economic and structural conditions to their loans. For example, like 2010, Greece will be a fantastic example. However, the United States' recent $20 billion support package to Argentina appears heavily driven by political and geopolitical considerations. And while China, sorry, thank you. Appreciate it, thank you. Same out too.
You just got a lot taller.
While countries like China increasingly provide financing with fewer conditions, in this context, what will be the future role of international financial institutions such as yours when great powers use loans as instruments of geopolitical influence? Thank you.
Okay, thank you. I was going to ask you about the BRI, but I was too polite. But you got the question now. Yes.
Hi, my name is Ramasi. I am a student at George Washington, and I'm a major in international affairs with a concentration in international economic. I would like to ask you, you mentioned integrated international trade, but oftentimes it's undergraded for regional change. Would you mind elaborating on that?
Regional supply chains, was that the question?
Yes.
Yeah.
Okay. You want to go with these 3, or do you want to take more?
Maybe last one.
Okay, please.
Wonderful, made it. Hi, my name's Alex. I'm senior here at GW, and my question for y'all would be, what do you think of the role of non-banking financial institutions, NBFIs, in sort of the work of the IFC and like what you mentioned earlier with the ratios of a third? Where does NBFIs get into that, and sort of how does that interfere or support the regulations of that? Yeah, thank you.
Now let me start with your last question, the last question. Thank you very much. The trend has been now to see more and more to support SMEs and also to have more and more non-banking financial institutions. That's really the trend. And you are seeing also, if you look at the data recently, you will see more and more private lending now. And so that's a new trend, and I think it will be increasing over time. And I think it gives you an opportunity to think about regulation in countries. As you know, we had Basel III, people are talking about Basel IV and so forth. There are a lot of, on the traditional banking institution, very, very stringent requirement in terms after the 2008 and 2018. And people have been more and more now looking with the regulator about sandbox regulations that allow non-traditional banks to be able to provide, to be intermediaries to financing. So you will see more and more that. You see even now large banks being fully digital. For instance, in Latin America, Nubank. Nubank is from the beginning was created in Brazil as a digital bank, which was not a thing. And you will see some interesting situation because, in fact, the most traditional countries, I would not say Europe, but some of them being located there, because their regulators are so used to regulate banks, they have been less open to innovation than regulator in developing countries, which have allowed them to create quickly digital banks and things like that. So the innovation on non-banking financial institutions, I think, will be coming a lot from the emerging markets. That's where you are seeing people leapfrogging and be able to support. And when you want to talk about SMEs is important because these people are much more agile in thinking about risk assessment. So we use the data from cell phone usage to assess the risk of a SME or using or the proxy to be able to react quickly, use AI and so forth and so forth. Mm-hmm. So this is a growing trend, and if you are working on that, I encourage you to continue doing that because it will be an area growing. SMEs navigate in this risk environment. I think this is linked to the issue of sub-regional value chain. Let's look at a few trends. You have now in emerging countries a growing middle class in cities, which have when you see some cities having an increase in their productivity, and I think that demand can be fueled a lot satisfied a lot by the network of SMEs if they are well organized and not necessarily going for export. Let me see in my country, for people like, for instance, to eat sorghum. Okay, in the past, the sorghums would come from the rural area, and it's not ready for sophisticated consumption. It's labor intensive. Now you have a group of small and medium enterprises who are doing that, transforming it, meeting the standard of the middle class in the cities, and by doing that, they are able to export as well. Okay, so in the country, there's a stage in terms of quality that they're able to match to be able to export. So it will not be a linear link, but it will be some things like that where you can build. Secondly, there is, with a critical mineral, a willingness of country, and that will be one of the big requests to see if part of the transformation, primary transformation of the critical mineral can be done in those countries. That require a lot of specialization because those processes are complicated technologically, sophisticated. You have countries which are, the supply chain of these critical minerals. So how those countries can be part of it, that's something that will be. When it comes to Argentina, actually, I should turn to Mr. Leipziger because that was his favorite country in the past. But finance and politics, how finance is used for politics, it's a long story. It's another cycle, and let's leave it like that. And I will not be talking about it more. Okay. And I think that Mr. Daniel Leipziger Professor Leipziger is much more equipped than me to talk about Argentina, because I think he spent.
Okay, I'll be selling 100-year Argentina bonds later in the lobby. But let's come to the BRI, and which is very relevant for Africa and infrastructure. The second question.
What is BRI? I don't understand.
BRI, Belt and Road Initiative,
oh,
you know. Come on. Yeah, okay.
I was asking what it means. I didn't know that acronym, so.
Okay, well, let's go to the regional value chains,
yeah.
Then you can decide if you want to handle a BRI or not.
So I think that the regional value chain is that I just give an example. if you take a continent like Africa, people are producing a good, they export it to another part of the world for basic transformation, and it's reshipped to the continent in another part of the continent. That's why people are saying it doesn't make sense.
Yeah.
So we need to really to do some primary transformation. Just give you simple things. Cashew nuts. The technology is not complicated. Okay? Just to grill the cashew nut, to separate the different categories which are broken, which are big. It's not rocket science. A lot of countries were exporting it, and it was done in other part of the world, packaged there, and we export it. So even starting by things like that,
Yeah.
we make a bit of difference in terms of value addition in those countries. And there are other sectors that are for me, you can. People are talking also about some of with the cost of logistics, that are sectors which are simple technology, how people can do the transformation in situ, instead of having to do an other impact it can have on climate change and so forth and so forth. So this is what I'm talking about, and it requires not only infrastructure, but it requires also a political will, because you will realize that sometimes people are focusing a lot on the infrastructure, the physical infrastructure. Do I have a road? Do I have a railway? Yes, it's important. The problem is also how many times to stop someone on the road when they want to move a truck from one place to another. That's why our Be Ready report is looking at all these kind of things. But those are as important as the physical infrastructure that you are building in a country. And we go back to the policy reform and all these kind of issues.
Yeah. No, I think that's exactly right. And the geopolitical pressures make this regional trade even more important. A lot of countries like yours or Ivory Coast, 90% of their trade is outside their regional area. So there are opportunities there that can be met. So this tells us that we are -2, which is not bad. So please join me again in thanking Makhtar Diop.
Thank you.